In 301 AD, the Roman Emperor Diocletian issued the Edict on Maximum Prices, capping the cost of over 1,200 goods and services. The penalty for violating these price controls was execution. Within 2 years, the edict collapsed. Markets went underground. The denarius, Rome's currency for 500 years, became worthless. But here's what most historians don't mention. While the official currency died, gold solidi retained their purchasing power for another century. The pattern isn't unique to Rome. In 1923 Germany, a loaf of bread cost 200 billion marks. In 1933 America, banks held $41 billion in deposits, but only $6 billion in reserves. 3 different crises, 3 different centuries. One asset survived all of them unchanged. The Roman denarius started as 95% pure silver in 64 BC. By 260 AD, it contained less than 5% silver. Emperor after emperor clipped coins, melted them down, and reminted them with more base metal. The process was gradual enough that most citizens didn't notice until it was too late. A denarius that could buy a day's labor in 200 AD couldn't buy a loaf of bread by 300 AD. The mechanism was simple. Rome needed money to pay its armies, fund public works, and maintain the empire's sprawling bureaucracy. Instead of raising taxes directly, emperors debased the currency. Each new coin looked identical to the old one, but contained less precious metal. Merchants noticed. Prices rose. The government blamed greedy merchants and imposed price controls. The real problem, currency debasement, continued unchecked. This same playbook appeared in Weimar Germany 1,600 years later. After World War I, Germany owed 132 billion gold marks in reparations. The government couldn't raise taxes without triggering revolution. The solution? Print money. The Reichsbank expanded the money supply by 1.3 trillion% between 1918 and 1923. A single gold mark could be exchanged for 1 trillion paper marks by November 1923. Then came America's turn. Between 1929 and 1933, the money supply contracted by 30%. Banks failed at a rate of 70 per month. Depositors lost $1.3 billion in savings. President Roosevelt responded by confiscating gold, devaluing the dollar by 40%, and expanding government spending by 50%. 3 different mechanisms, 3 different outcomes, but one constant: paper currency failed its holders. Rome's collapse took centuries, but the final acceleration was brutal. Between 235 and 284 AD, Rome had 50 emperors. Most were murdered. The army demanded payment in gold or silver, not debased coins. Tax collectors began accepting only precious metals. The denarius became what economists call token money, worth only the value people agreed to pretend it had. Farmers stopped selling food for currency. They wanted gold, land, or barter. Cities depended on grain shipments that now required payment in precious metals the government didn't have. Urban populations starved or fled to the countryside. Rome's population dropped from over 1 million in 100 AD to under 30,000 by 500 AD. But here's what most people miss. Wealthy Romans who held gold preserved their purchasing power. A gold solidus bought roughly the same amount of goods in 400 AD as it did in 300 AD, even as the empire crumbled. Land also retained value, provided the owner could defend it. Skills, especially metalworking, farming, and medicine, became the new currency. Paper wealth vanished. Physical assets survived. Fast forward to Weimar Germany. In January 1923, a dollar bought 18,000 marks. By November, a dollar bought 4.2 trillion marks. The velocity of collapse matters. The German middle class held their wealth in 3 primary forms: savings accounts, government bonds, and life insurance policies. All were denominated in paper marks, all became worthless. A German doctor who had saved 100,000 marks over 20 years, enough to buy a house in 1918, couldn't buy a loaf of bread by 1923. Professionals sold family heirlooms for food. Doctors drove taxis. Engineers washed cars. University professors chopped firewood. The social order inverted. Those with tangible assets thrived. Those with paper assets starved. But the pattern reveals the survivors. Farmers who owned land kept producing food. Manufacturers who owned factories kept producing goods. Individuals who had converted savings to gold in 1920 preserved wealth through the crisis. A single gold mark in 1918 remained a gold mark in 1924. The purchasing power was identical. The paper mark holders lost everything. The Great Depression followed a different script but reached the same conclusion. American banks operated on fractional reserves. They held only $1 in gold for every $10 in deposits. When depositors panicked in 1929, the math turned lethal. Banks couldn't honor withdrawals. They failed in cascading waves. 9,000 banks collapsed between 1930 and 1933. The government's response created the crisis's second act. Roosevelt banned private gold ownership on April 5, 1933. Americans had to surrender gold coins, bullion, and certificates for $20.67 per ounce. The penalty for hoarding was 10 years in prison. Then, after confiscating gold, the government revalued it to $35 per ounce, a 69% overnight devaluation of the dollar against gold. Citizens who held paper dollars lost 40% of their purchasing power. Those who had converted to gold before the confiscation or who hid it and avoided the mandate preserved their wealth. Land values crashed during the Depression, but ownership of productive farmland provided food security when currency couldn't buy groceries. Skills became currency again. A mechanic could trade repairs for food. A carpenter could build in exchange for shelter. The pattern is unmistakable across all three crises. The sequence repeats. Government overspending leads to currency debasement, which triggers inflation, which causes social disruption, which invites authoritarian controls, which accelerate the collapse. Paper assets denominated in the dying currency become worthless. Physical assets retain value. Skills create value independent of currency. Gold survives because no government can print it. First, gold. The metal survived every collapse unchanged. A Roman gold aureus, a Weimar gold mark, and a pre-1933 American gold eagle all retained purchasing power when paper currency failed. Gold's advantage wasn't growth, it was preservation. 1 ounce of gold bought roughly 350 loaves of bread in ancient Rome, 350 loaves in Weimar Germany, and 350 loaves during the Great Depression. Second, productive land. Agricultural land maintained value because humans require food, regardless of currency stability. Roman landowners who could defend their property survived the empire's collapse. German farmers weathered Weimar hyperinflation. American farmers during the Depression struggled but retained their productive capacity. The critical distinction: land had to produce food, fuel, or raw materials. Third, essential skills. When currency fails, barter economies emerge. Blacksmiths, carpenters, doctors, farmers, and mechanics could trade services for goods. The Weimar era created a brutal meritocracy. Lawyers and bankers starved, while plumbers and electricians thrived. Skills that created or repaired physical goods had value. Skills that shuffled paper assets had none. Fourth, stockpiles of non-perishable goods. During hyperinflation, anything tangible beats currency. Weimar Germans bought goods immediately upon receiving wages, before prices doubled again. Cloth, tools, canned food, fuel, and building materials became stores of value. The principle: real goods retain utility when money doesn't. Fifth, relationships and community. The historical evidence shows survival rates diverge sharply based on social networks. Roman citizens with extended family in the countryside fled cities and survived. Isolated urban dwellers starved. Weimar Germans with rural connections obtained food when city markets emptied. Depression-era Americans in tight-knit communities shared resources and weathered the crisis better than isolated individuals. What failed tells the inverse story. Government bonds became worthless in all three crises. Pensions evaporated. Savings accounts bought nothing. Life insurance policies paid out in devalued currency. Cash under the mattress lost purchasing power daily during hyperinflation. Financial assets denominated in the collapsing currency offered no protection. The contemporary economic landscape mirrors pre-collapse patterns with unsettling precision. The United States money supply expanded 40% between 2020 and 2022, the fastest peacetime expansion in history. Total federal debt exceeds $34 trillion, or 122% of GDP. The ratio matches America's debt level in 1946 after financing World War II. But here's what most people miss. Rome debased currency to pay armies. Weimar printed to pay reparations. America prints to fund deficits. The mechanism is identical, only the justification changes. Central banks globally hold interest rates below inflation rates, creating negative real yields. Savers lose purchasing power by holding currency. Modern parallels extend beyond monetary policy. Rome imposed price controls when inflation accelerated. Germany blamed speculators for rising prices. America debates price gouging laws and windfall profit taxes. The strategy for wealth preservation remains unchanged from ancient Rome. Physical assets outperform financial assets during currency instability. Gold trades at $2,000 per ounce currently, but its real value is measured against other goods, not dollars. Productive assets, farmland, rental properties, businesses that create tangible goods, retain value when currency doesn't. The key distinction: productive versus speculative. A factory that manufactures tools will produce tools regardless of currency stability. Skills matter more during instability than credentials. An electrician survives when a portfolio manager doesn't. The lesson from Weimar applies today. Develop abilities that create or repair physical goods. Learn skills that have value in barter economies. Build relationships in local communities. The contrarian position isn't that collapse is imminent. The position is that collapse is inevitable given current trajectories, and the timeline is unknown. Rome took 3 centuries to fall. Weimar took 5 years. The velocity varies, but the destination is determined by the path. 3 crises across 2,000 years teach one lesson. Paper currency fails, physical assets survive, skills create value, and gold preserves purchasing power. The next video examines what happened to property rights during currency collapses. Specifically, how governments confiscate assets and what assets prove impossible to seize. The pattern is darker than the currency story, but more actionable for protection strategies. Subscribe if the goal is understanding the system instead of just participating in it. Financial education isn't about getting rich. It's about not getting destroyed when the system resets. Most channels tell viewers what to buy. This channel explains what survives. History has the answers. The question is whether enough people are willing to look.